Bitcoin just dropped 2% last night. But don't freak out yet. This fall may actually be one of the strongest bullish indications we've had leading up to a Federal Reserve meeting. Over the next few minutes, I will explain what's actually going on with Bitcoin, why this price drop is not chance, and how it could be building up to one of the largest moves we've had all quarter. This is an analysis you just can't afford to miss. So let's get started. Hello and welcome to Crypto Peek. Today's subject matter is huge, and we're really going to drill deep. We'll be discussing Bitcoin's 2% daily plunge, the patterns in the past that play out leading up to every FOMC meeting, what whales are secretly doing in the background, the technical levels you need to watch with your life, the on-chain data that tells you where big players are positioned, and lastly, the possible scenarios that may develop in the next 72 hours. If you stick with me to the very end, I'll also give you my own approach, how I'm navigating this volatility as both a short-term trader and long-term investor. So grab a coffee, shut down your trading software for a sec, and let's take it all apart together. Bitcoin daily plummet reaches 2% as traditional BTC price action leads up to FOMC. But that's concealing a much larger tale. For newer investors, a 2% swing can be dramatic, but in Bitcoin parlance, that's just another day at the office. Where this move stands out is when it happened. Over and over again, we see this same type of dip leading into some huge macroeconomic event. Most notably, leading into FOMC meetings, when the Federal Reserve makes its interest rate stance official. The behavior is so regular that most analysts mark the trend as classic price action. The market de-risks in anticipation of the major announcement, which results in temporary bear pressure. Following this, based on what the Fed ends up saying, the price tends to whipsaw violently in the opposite direction, catching late sellers by surprise. Let's take a step back and look at why this occurs. The FOMC, or Federal Open Market Committee, is the institution that determines interest rate policy within the United States. Their action has an impact not only on the US economy, but on world financial markets. That's why crypto matters. As interest rates rise, it becomes more costly to borrow. This squeezes liquidity and reduces the appeal of risk assets, such as Bitcoin. When interest rates fall or remain constant, liquidity increases, and investors are more inclined to take risk. But it's not just the decision itself. It's the language the Fed uses. Traders watch every word from Jerome Powell and the FOMC press statement, looking for clues about future policy. Are they signaling more hikes? Or are they suggesting we're near the end of the tightening cycle? That is the extent of the setup. This expectation itself generates uncertainty, and uncertainty generates volatility. Intelligent money tends to take advantage of this time to either take profits off the table or quietly build up positions, expecting retail traders to overreact. Let's examine the chart of Bitcoin, because the chart does not lie even when the news is cacophonous. At the moment, Bitcoin is just above an important support zone at $26,000. It's been tested several times over the past month, and it has served as a good floor. The close below this level could set up $25,000 or even $24,500. But so far, buyers have been jumping in each time price falls into this range. On the positive side, $27,500 continues to be the nearest resistance. A break above here on big volume could send Bitcoin easily towards $28,500 and even $29,000, which had witnessed intense selling pressure in the past. The 4-hour chart RSI is approaching oversold levels, which tends to lead to a relief bounce. The MACD is flattening out, indicating possible momentum change if we see bullish follow-through. The Bollinger Bands are tightening, which usually means a volatility expansion is coming. In other words, a big move is near. Volume profile shows something important. Selling pressure during this dip hasn't been overwhelming. This suggests we're seeing a controlled pullback, not a panic-driven sell-off. This is where it gets interesting. Each time Bitcoin plunges ahead of an FOMC meeting, social media fills with dread. Here comes the crash. This is the beginning of the next bear market. But what really goes on behind the scenes? Big players, whales, funds, and market makers are providing liquidity. They push price down just far enough to hit retail stop losses and blow out over-leveraged longs. Once they have provided liquidity, they quietly refill their positions at lower prices. This is why we refer to this as classic price action. The market puts on maximum fear, absorbs shorts, and then turns sharply after the news, catching everyone short who sold too early. So, what can really happen when the FOMC speaks? There are two basic scenarios we must be prepared for. If the Fed leaves rates alone and gives softer guidance that implies future hikes are not on the horizon, Bitcoin might rally extremely hard. The initial target would be recouping $127,500. But if short sellers are pushed to cover, we might have a rapid shift back up toward $128,500 or $129,000. If the Fed hints at yet another hike or suggests rates need to stay higher for longer, we might see one more leg down with a possible retest of $125,000 or even $124,000. Altcoins would get hurt even more since they are more illiquid and volatile. But the point here is that even in a bear case, markets tend to overreact on the day of the announcement and then reverse in 24 to 48 hours as rational people step in. Current on-chain data indicates that exchange inflows are marginally higher, which means some of the holders are getting ready to sell or hedge. However, futures open interest is rising, which suggests that traders are positioning aggressively for a large move. Funding rates are even, meaning there's no significant preference for longs or shorts. This is a powder keg situation, the type of configuration that can result in a violent move in either direction once new data arrives on the scene. So what's the intelligent play here? If you're a long-term investor, the answer might be to do nothing. A 2% dip is barely a blip on the radar for Bitcoin, and historically, these pre-FOMC dips have been excellent accumulation points. If you're a trader, the play is to stay nimble. Don't take massive positions before the announcement. Wait for confirmation after the FOMC decision, then trade with the trend. Tighten your stop losses and manage risk carefully. Volatility can wipe out undisciplined traders quickly. And if you're just watching from the sidelines, this is a great time to plan your entries and exits. Set alerts at key levels so you're not caught off guard by a sudden move. This also provides a good chance to see how macro events such as FOMC meetings interact with crypto. Crypto does not live in isolation. It is still tied to global liquidity conditions. As the Fed tapers, risk assets get hit. As they cut, risk assets pump. That is why serious investors always keep an eye on macro. It's not only about the Bitcoin chart. It's about the dollar index, bond yields, and liquidity flows. When you see these forces, you stop responding emotionally to price drops and begin to position rationally. Okay, I've given you my complete analysis. Now it's your turn. Is this dip a setup for a large rally or the beginning of a more significant correction? Leave your comments below. If this in-depth analysis made you look at the bigger picture, like this video, subscribe to Crypto Peak, and share this video with your other crypto buddies. The more we know, the tougher it is for whales to dictate to retail traders. Remain vigilant, remain up to date, and don't forget, this is Crypto Peak, providing you with the sharpest insight into the crypto space. I will catch up with you shortly after the FOMC meeting with a complete update and my subsequent price projections. Stay safe.